second. I just want to make sure, Cindy, I just want to make sure she's ready with the slides.
Oh, the other Cindy.
Cindy Rivera, sorry.
Hi, yes, I have them ready.
Okay.
Okay, it's 8 a.m. and I'll call this meeting to order. Before we begin, we'll have some quick housekeeping rules. Linda, go ahead.
It's actually going to be Cindy.
Sorry, Cindy, go ahead.
Cindy Lachey.
Sanchez, hi.
Hi.
Thank you, Chair Sanchez. This meeting is being conducted as a virtual meeting, so I will do a roll call of the trustees to confirm attendance. Mr. Knox?
Here.
Ms. Greenwood? Mr. Jones?
Present.
Mr. Kelly?
Present.
Ms.
Present.
Sanchez?
Here.
Staff participating in the meeting include Chief Investment Officer Jonathan Grable, Chief Executive Officer Santos Kremer, Interim Chief Counsel Johanna Fontenot, Principal Investment Officer Vache Masaridou. Consultants participating in the meeting include Tom Cockwell, James Walsh, and Stephen Kennedy of Allborn, Jonathan Dorfman of Napier Park, Leandra Festino, Stephen McCourt, Alina Wan, and Timothy Fia of Makita. Trustees, if you have a comment or question on any item, please use the Zoom chat option to be placed in the queue. At this time, we ask all meeting participants to mute their mics until you are ready to speak. Now we'll proceed with the agenda.
Thank you. And before we begin, I'd just like to extend a special welcome to our newest member, Mr. Patrick Jones. Thank you for joining us. This is when things get real.
Yeah.
So we'll kick off with the approval of the minutes. Do I have a motion?
Keith, I'll move approval. Oh, I can't move approval.
Keith, yeah, you're Joe. You are a voting member this morning.
Oh, I am. Okay, I'll move approval. I'll second.
Thank you. Thank you.
I just wanted to make one note about the minutes that they actually started at 1:30, even though, and it's reflected as 1:30, but in the header it shows 9 a.m. because that's consistent with the agenda.
Thank you.
And now I'll take roll call. Mr. Knox?
Aye.
Ms. Greenwood? Mr. Jones?
Aye.
Mr. Kelly?
Yes.
Ms. Sanchez?
Yeah.
The motion
Okay,
passes.
moving on. Thank you. Moving on, do we have any public comment?
We do not.
Okay. And on to the report. So we'll go ahead and take the first item, which is an overview of Asian private credit. I'll hand it over to Vache Masarajian and Tom Cockwell from Allborn. Go ahead.
Good morning, Madam Chair, committee members and trustees, and a special warm welcome to our LACERA's newest trustee and board member, Mr. Patrick Jones. This morning, we have two guest speakers who have graciously agreed to discuss credit markets with us. As we endeavor to build out the credit portfolio, we're constantly searching for markets and strategies that offer attractive income, generate a return stream that diversifies the portfolio, and carries risks that are manageable. One such potential market is Asian private credit, and we've invited Tom Cockwell, who's head of Allborn's private markets research, to talk to us about Asian private credit. So I'll turn it over to Tom.
Thanks, Vache. Good morning, everyone. And as Vache mentioned, I'm head of private markets research at Allborn. And this presentation is a fairly high-level overview of Asian private credit, but should serve as an introduction to the space. You should hopefully have the presentation in front of you, but we'll also be going through with it on the screen in front of us. I've got about 20 minutes of comments and then happy to answer any questions. So as a reminder, Allborn has a team of about 30 analysts on the ground in Asia, covering the breadth of the market, which includes private credit. And we've been covering this space for over 20 years and have been able to watch it develop and mature. If we go to slide 2. So this first slide goes over why I'm here today. It's to highlight this space, and the reason is this is an attractive area to invest in with good returns and attractive relative risk compared to European and US credit. Also, those two areas, US and European credit, are places you already have considerable high quality exposure to. At this time, you have very limited exposure to Asian private credit. So with regards to returns, for senior loans backed by first or second liens or real estate, one can get a 10 to 15% type return, so attractive returns. It does depend on the complexity of the transaction. And these returns are generated with limited fund level leverage, typically maxing out at around 30 to 40% of the fund, rather than in the US, where fund level leverage is extremely variable, but some participants will be very highly levered, for example, 90% levered, and that will impact pricing across the space. Those participants aren't active in Asian private credit, and the pricing is more attractive accordingly. Also at the asset level, that is the underlying investments in the fund, these are also typically less levered, with loan to values of 10 to 50% versus the collateral package versus a more common 60 to 70% in the US and Europe. These are very high level numbers. If we go on to slide 3. So the next slide talks about why there are attractive returns and one doesn't need to use so much leverage. And that's the simple reason this is a less competitive market. I'll get into some of the reasons it is less competitive on the next slide. On the pie chart on the left, if we go back a slide, thanks. In the pie chart on the left, if you think of the US, Europe, and Asia and treat them very roughly as equally sized economic entities, you can see just how little relative private credit is available in Asia. Also, the number of funds in Asia adds up to about 70 to 80 participants, and that would compare to, say, about 800 in the US and Europe. So again, just a lot less providers of this type of solution-oriented capital competing with each other and driving down returns. If we go to slide 4. So as well as being a large economic entity, Asia is a particularly diverse one as well. So as well as China, you've got India, Indonesia, Japan, Korea, all with unique economies and opportunity sets. So there's a great deal of diversification within the Asian opportunity set. And then each of those countries are also diversified from what's going on in Europe and US. So this is highly diversifying. And I'll discuss on the next slide how this complexity and diversification creates an opportunity. The last point I want to make on this slide is, for purposes of sort of breaking up the credit universe, we group Australia into Asian private credit, even though it's actually in a different continent, but it is covered by a lot of the same managers and it shows up in a lot of the same funds. Thank you. So there is a reason there aren't more investors in this space, and at its core, the reason is it's always been very complex to invest in this space, and historically there have been material structural hindrances to funds investing in the region. However, over the last 10 years in particular, a lot of these headwinds have lifted, and there are material structural positive changes that have made investing in the space a lot more attractive, as long as you are working with appropriately skilled funds. So the way these factors are laid out on the page, they can be looked at as either structural or cyclical, and either global or regional. And I'm not going to go through all the points, but first looking at the global considerations that are going to drive returns in this space. The first off is global banking sector regulation and reform in all geographies has meant there's more reluctance for banks to make special situations loans or complex loans, and that creates a space for these funds to invest. The last 12 months on our cyclical based issues, on top of cyclical issues, the last 12 months have also seen all countries have to adjust for the impact of COVID-19. That's impacted Asia as well and created distress and growth opportunities that need credit. And then the sector specific issues for consideration, such as leisure or semiconductors, are both going through cycles in the US, in Asia at the moment, just like the US. But there's also the regional consideration of the deteriorating credit cycle. It says on the page here. I think the point here is that there are, in terms of cyclical factors, that's not the reason to invest in Asian credit. It's not because it's a particularly attractive point in the cycle. In practice, pricing in Asian credit was marginally better 1 or 2 years ago. But so it's somewhere in the midpoint of the cycle. But any of considerations around this are more than counterbalanced by considerable structural opportunities which are specific to Asia. And that's in the top right corner. The first point and key point is growth. Asia is growing significantly faster than any other major region, and it needs capital to support this growth. The second one I will highlight further is the poor price discovery. There's very little transparency over what terms market participants have got on their loans and what interest rates are available to borrowers. And this makes it a lot easier for specialist funds to create proprietary deal flow and get attractive terms, and makes it a lot harder for non-local investors to competently participate and compete in the market. If we go to slide 6. So this slide shows our taxonomy for Asian credit and shows the diversity of strategies from distressed on the left to performing on the right, and the wide range of subcategories. And then for each one of these subcategories, there's each geography will have its own opportunity set and expected returns and specific risks. So if you're choosing a manager to invest in this space, they'll have a particular blend of these strategies. I'll come to that further shortly. And while we'll be looking at all strategies, I would highlight the ones most likely to meet LACERA's target returns with manageable risks will probably be on the primary lending side at this time. And so more asset-based lending, special situations, or cash flow lending. So while there may be some distressed options, it's less likely to be the initial recommendation in this space at this time. We go to the next slide. So the next 5 slides, they go through some of the subcategories in more detail. Each one of these spaces have market participants who are doing a good job of generating appealing returns. However, I've circled in the presentation in red the strategies which all bonds analysts think are most attractive on an absolute and relative basis at this time. And I'll highlight a couple of these. As mentioned, we can return to this in future meetings in as much depth as needed, and we'll be working through in detail with your team the exact risks and opportunities in each one of these spaces. So, so if we go back up a slide to the thing, thank you. So starting in China, the 2 strategies I'll highlight on this slide are 2 lending strategies where the security is either real estate, it's typically residential real estate, and special situations loans. to either high net worths or to corporates. And in each case, there is extensive scope to customize the exact collateral package for the loans. That is, the properties or assets will belong to the lender in the event of default. And in each case, there is extensive scope to structure these investments to avoid or minimize default risks. The extreme case is what is available in parts of Asia and one doesn't get in the US, are structures where the lender will actually have legal ownership of the asset until the loan is paid off. So in the event of default, they don't need to enforce their rights through the courts. They already own the assets. Of course, this type of structure only works if you have people on the ground who know how to implement and manage any issues that arise. With regards to the risk, the main challenge is that sourcing, setting up and exiting investments is highly complex and requires considerable expertise in the relevant jurisdictions and ownership structures. The funds we will be discussing with your team are all groups with the necessary skill sets to avoid falling foul of regulatory hurdles and know how to source and identify investments, how to handle collateral packages, which might be based in multiple jurisdictions. And as an example of this, one might have a borrower, which is a corporate entity in China, but is owned by a Singapore-based high net worth individual who might also own real estate assets on Australia and then some shipping assets. And then all those assets are used as collateral for the loan. Evaluating that type of collateral package and having a viable means to enforce one's rights in the event in any default scenario, it is challenging and requires an appropriately experienced and resourced manager. If we go to slide 9. So as mentioned, Australia is grouped into Asia for these purposes. Of this peer set, Australia serves as a market that these funds invest in that's the most like US and Europe with regards to its legal structures and corporate culture, but it's less competitive than those markets. LTVs are, so it's just less competitive than those markets. If we go to slide 11, as collateral for the loan, viable means to. So go on slide 11. This is India is a higher risk market with considerable currency risk that needs to be hedged out, but corporate loans to support growth investments do have very attractive profiles at the moment with equity-like upside and decent creditor protection. So I did highlight one strategy in India at the moment. And next slide. The last two sub-strategies I'll highlight. One is corporate special situations lending in Japan and Korea, often to help support restructuring conglomerates or manage corporate succession. These are markets with good creditor protections, are very hard to access, which reduces competition. And similarly, providing special situations lending in Southeast Asia. And that's more like investing in China, where one often needs to structure the investments to avoid local courts, and collateral packages might be located outside the sub-region. So those were the strategies that the funds in this space allocate to. I've just got a couple of slides to finish up on that go over the structures that are used by these funds. So first of all, with regards to how long the lockup of these funds, they generally have a 4 to 7 year life. So not as illiquid as private equity, but more illiquid than most of your US illiquid credit holdings. There are some funds which are shorter duration, focused on the most senior and slightly lower returning strategies. And also there are private equity equivalent vehicles for investing in distressed strategies, but we'll probably be focusing initially on the sort of left-hand side of this chart. I won't go through all the terms, but the simple version is costs are roughly equivalent to the sort of fees one would see in the US and Europe for complex special situation funds. Carry is at the 15 to 20% level, management fees at 1.5 to 2%. Currency hedging is an issue, but most funds will offer a hedged USD based share class, and all the returns I've mentioned previously in this presentation all incorporate any hedging costs. So as the LACERA staff review the options to allocate in this space, there are around 80 funds to triage. Allborn knows them all and has focused our coverage on about 30 managers. Asian credit funds are typically smaller compared to US and European equivalents. They're in the $500 to $1 billion fund size range. So for an investor of LACERA's size, this does to some extent limit the volume of access to the strategy. The last key point in this slide is nearly all market participants invest in a range of the strategies I've just talked to. So the table below gives an example of the type of exposures these funds might have. You might have one fund doing distressed for control and NPLs in Australia, Japan, Korea, and India. Or you might have a fund doing cash flow lending and special situations in China and Southeast Asia. So rather than having a narrow focus on a single space, most participants look to internally diversify their portfolios across a number of these strategies and allocate to whatever they find most interesting. And to conclude, so this area, it is a very attractive looking investment space at the moment, and we do see a lot of clients invest in this space to deliver alpha and diversification to their portfolios. However, as mentioned, the space is not that large, and we typically see clients invest in the space as a small satellite exposure to credit portfolios. So while if you feed the expected risk and return and correlation stats of Asian credit into an optimizer, the optimizer will suggest a very significant allocation to the space. In practice, clients typically invest in 1 to 3 names that might represent about 5 to 10% of their private credit portfolio. So this is might be a satellite part of a portfolio, providing some additional return and diversification. Those are my comments. Very happy to answer any questions.
Great, thank you for that. I'm going to take the chairwoman's privilege and begin the round of question asking. First, I'll just make a comment on your last comment about the optimizers' desire to purchase up credit. And that's because optimizers do not do well with nonlinear risk. And so credit has a Poisson distribution, so it will never really be effectively, I think, modeled in optimizers. So I'm going to begin my round of comments in China, and obviously there's a couple of, credit broadly is a very difficult thing to sort of give a high level presentation, because it is highly determined by the contractual obligations. So how the contract is written is almost, the majority of the risk that you're taking, but also the bankruptcy process, the role of the government, and kind of other factors that really are understanding the legal system around property rights and default are also key in understanding these. So I'm gonna start kind of along those lines in China. Right now, China is experiencing a couple of things. One, the Chinese government has started to crack down on their shadow banking sector. And we saw that in the very surprise collapse of one of their most recent IPOs, which was the Ant IPO, which was expected to be the largest IPO in the world. And so it's fascinating to see sort of the degree to which deleveraging is occurring at that level. But it's also happening at a time when the government has shown itself to be more willing to allow banks, rather more willing to allow credits to fail. And the role of the government right now in that bankruptcy process, I think still mucks up the bankruptcy process. And so I'd love you to sort of speak a little bit about that. And then, of course, lastly, you have the issue. Well, I lost my train of thought. I don't remember what my last issue is, but let's begin there. Oh, lastly, sorry, I do remember. Is the issue of financial disclosure and the question as to whether or not you're dealing with adequate financial disclosure, or quite frankly, correct financial disclosure with some of these companies. And so, I think there's a lot of issues. China seems to be at a turning point in terms of how much they have been allowing their credit to build for the last several decades. And one of the areas that you focused on was residential real estate, which is a space that has always suffered from the fact that Chinese policy has never favored wage growth. They have always put it in their 5-year plan. This is a country that can execute a 5-year plan, but has never accomplished that in multiple 5-year plans. And we've only just recently started to see wage growth in China. And that is rather key to sort of supporting residential real estate lending. So that's a lot of items, but I wonder if you can kind of unpack a couple of those for me, and then we'll move on to the next questions.
I can give some pretty high level responses to that, and in practice, before proceeding with any investment, we'll need to provide enough information, or the fund manager would need to provide enough information, or the staff, to make sure you are comfortable with these issues. The first point is there's absolutely tail risk in investments in China, and the key way that funds can manage that is through diversification. You don't have all your money in China. It'll be a portion of the fund. And the other point is, by using shorter duration funds, that can also help mitigate some of the tail risks. If some of these things go wrong, it's not going to be a sudden snap, it's going to be a build up. And by a shorter duration, it means that there's one doesn't have to, if things stop trending in the right direction, your money can come back to you quickly. So I think those are the first two things. I think with regards to the role of government, one thing is staying out of the right sectors. There's some sectors which are more where the government is more active, that there's greater risk if you're lending into those spaces. Another point is sticking with low LTVs. Just that can save a lot of stuff. If you're lending at 10% LTVs, you can endure quite catastrophic economic conditions. And then the third point would be collateral packages outside of China. So even if you're lending into China, you're actually collecting on the loans in Australia. So in the interest of time, I'll stop there, but I know I haven't fully answered your question. There isn't a full answer to your question.
I understand. Okay, we'll move on. Mr. Santos, you had the next question.
Yes, thank you. And good morning. Thank you for that presentation. Ms. Sanchez took my questions in my concerns. Quite frankly, the lack of transparency, the bankruptcy issues, and the fact that China's behavior on the world stage, it really troubles me. Now, I want to state that I understand the growth and the opportunity level there. I get that, and I understand that given the size of the economy, at least for China, that we need to play in China, but we need to be really, really careful. We need to go into this space with the wide open eyes, fully understanding the risk level, because it is concerning. I'm not against investing in the region, but it is something that we really need to be careful in going with the wide open eyes. I will probably suggest to my colleagues that perhaps before we hire any particular manager, that we should interview those managers at the end, because I just want to make sure that we do not make a mistake. So those are my comments.
Thank you, Mr. Santos. Mr. Knox?
Thank you. Appreciate the presentation. Couple things. What was it that you said happened 10 years ago or so that started this trend for the headwinds to dissipate? And then after that, just are we going to see windows of opportunity where there are less headwinds? Or should we just anticipate? I mean, the risk is great, but obviously we shouldn't anticipate that it's just going to keep getting easier and easier. There's going to be ebbs and flows and windows of opportunity.
So I think first of all, 10 years ago that's a slightly arbitrary deadline, but it's the reforms put through into how they into how China started its deleveraging process and put through regulation to improve reform around bankruptcy and how these loans were treated and how there became more transparency and conviction in how various legal structures would be treated. But it is a continuum. It's not so much. It's been about 10 years ago we saw institutional investors materially start to allocate to the space. With regards to the cyclical point, the reasons to invest or not invest in this space, we would very much underscore our structural. Even at the cyclical conditions could be a lot worse, and it would still be, on a returns point of view, a straight sort of an attractive opportunity. It's things like a couple of years ago, sometimes entire portfolios were able to be put together from loans with sort of 10, 15% LTVs. Now it's probably more like 20, 25% LTVs for some of an equivalent portfolio, but that might compare to equivalent risk assets in the US or Europe at 70% LTVs. So it might be cyclically a bit worse, but I wouldn't, if one's waiting for it to be a better point in the cycle in Asia, that's not the main impediment. The main impediment I would underscore is what Ms. Sanchez mentioned, is these structural considerations.
Thank you.
Great, and I will take the last question, I guess. So I want to kind of come back around to a bigger, broader macro question. The pandemic has ushered in a period of pretty significant navel gazing around supply chains and the global logistical process. Logistics is key. China and most of Southeast Asia, and to that degree, even Australia have, these were originally export-led oriented development models, and China has spent the last decade attempting to grow its domestic demand. However, that export-led component is still key, and so there just seems to be an interesting shift around that. And do you have, kind of not thinking 1 to 3 years out, but sort of thinking more a decade out, any thoughts, or has Allborn sort of considered the broader macro implications of kind of a shakeup of the supply chain?
I think we spend quite a lot of time looking at that, but primarily on the equity side. For private equity funds, the dynamics you're talking about are extremely material, and I would say they would come into this space for distressed assets and the longer hold strategies. When these groups are investing, it is typically for sort of 2-year holds and based on existing valuations of assets with a big cushion, so that even if they're wrong in the direction of import-export trends, the assets they'll still have protection. I think that the main point in Asia is just that these economies are changing very fast, and being ready, having a big cushion to adjust for any changes over the life of your investment is important. But I would say it's something we more focus on than the equity side, and you can mitigate that risk by focusing on shorter holds.
I see. Okay, great. Well, thank you. Are there any last questions?
Yes, Ms.
Go
Sanchez,
ahead,
if I
Mr.
may.
Santos.
Yes, so obviously the investments are going to be in US dollars, but in China, all investors, the way I understand it, has to be in RMB. So what kind of vehicle are we going to be using to be able to invest in that in this sector and be able to pull our money out whenever we need to pull the money out, given China's restriction on money?
Yeah. So it would you'd invest in using an offshore structure, which would have a relationship with a regulated onshore entity. Basically, your point about the currency controls are very real. Any investment you make, you need conviction that the manager can put the money to work and then get the money out again. All of the managers have proven methodologies of managing the regulatory hurdles in doing so. But it is something one needs conviction on. It does vary very much by jurisdiction, whether it's China or some of the Southeast Asia locations. But yeah, that's it is a real issue, and but managers have a long history of managing it.
Great, thank you. And it looks like Mr. Jones has one more question. You're on mute, Mr. Jones. You'll get good at this after a while.
Yeah, no, it's the instance there. So good morning, Tom. So relative to some of my colleagues and their concerns about China, likewise, I do have some too. In the weighting of the funds that you'd be looking at, on average, or is the kind of pan-Asian look they have a overweight in China relative to other countries? Is there a way to get some visibility where these funds might perhaps, out of the options you have, might have perhaps less of a concentration in China without necessarily diluting the quality opportunities that match the strategy? Could you talk to us a little bit about that?
So one can absolutely invest in Asia while minimizing Chinese exposure. There are opportunities, as I mentioned, in Korea, Japan, India, Australia, that completely avoid the China space. In practice, funds, unless you're in a share class that excludes China, will slightly overweight China. The returns and central part of the risk distribution are more attractive in China. So those other regions are still attractive, and we would recommend, I think we would say exposure is beneficial, but yeah. So to your point, we can look for funds where Chinese exposure is reduced or minimized, and the funds still meet your target risk return profile.
Okay. Thank you, everyone. In the interest of time, I think we're going to move on. Thank you so much for the interesting presentation, Mr. Cockrell, and we look forward to looking into this sector more deeply.
Thank you very much.
So the next report on the agenda is by Napier Park Lake Credit Fund to give us an investment outlook. So I'll hand it over to Vatche Masarajian and Mr. Jonathan Dorfman.
Thank you, Madam Chair, and thank you, Tom. Our next speaker is Jonathan Dorfman, CIO of Napier Park. And as you will recall, Napier Park is an illiquid credit manager that LACERA hired in the first quarter of last year during the depths of the market turmoil. And they maneuvered through that turmoil with expertise, generated terrific performance for us. But the market environment has changed quite considerably since they started investing for us. And so we thought it might be interesting for you to hear from Mr. Dorfman about the different market conditions and how they've plan to modify the structure of the portfolio going forward based on the opportunities they see. So I'll turn it over to Jonathan.
Thank you very much. First of all, I just wanted to thank you for the opportunity to speak about this. We appreciate it. And it's a very interesting time because we're moving into more of a rising interest rate environment for the first time in a very, very long time. And so what I thought we would do is review with you our core investment view from a top-down perspective. And then how does that actually fit into what we think the best opportunities for you are that give you the returns that you're looking for, yet protect, from a risk perspective, LACERA's investments. So that's what I'm going to walk through. And then at the end, of course, we can have questions. The starting point, if we could just move to page 3, please. The starting point is our view of what's going on in the United States, because it is the largest economy in the world and is having the most economic support for the economy from the central government. So we do look at things globally, as was just mentioned, we're in a liquid credit manager. We have about 100 people, and this is really all we do. But one thing we're really focused on is difference in the US and Europe in terms of their approach to the pandemic and stimulus. And here, where we just have one government, it's easier to coordinate, is probably the simplest way to think about it. So what we've seen is an enormous increase in stimulus. It's more than quadruple the GFC stimulus. And the way we looked at it is just 1% of GDP. And that has resulted in a really remarkable improvement from the perspective of household balance sheets. And what's interesting about this is household balance sheets went into COVID in a pretty good situation to start with, if you look at it over a very long time series. And particularly when you look at kind of the cost of interest payments relative to household income, going into COVID, it was already at a 15-year low, and now it's gone below that because, of course, people have been given money. And there's some reasoning behind this. And I think from our point of view, we've been in the camp for quite a while that we are going to see very, very large GDP growth in the second half of this year. And that's going to result in really positive characteristics for credit and your credit investments, particularly in an environment where real interest rates remain negative, which is always really good for credit. So if a company can borrow money at a fixed rate that is below the inflation rate and deduct it, the actual cost of capital to them is, once you adjust for inflation, is very attractive and increases earnings. I think the big social issue is the disparity in employment change. And the graph on the right, there's a lot of graphs that show this, but we like the one on the right. And it's pretty concerning. You have about 7 or 8 million job losses in the bottom quartile of wages, and then you have job gains in the top half. And so our view of this is why the Federal Reserve is likely to, what I would call, run the economy hot and take some inflation risk. And they've already come out and said that their view of how they define their employment goal is now going to be affected by the employment and wages of the lowest group as compared to kind of the economy overall or some kind of average. And that's a meaningful change. And that means you may have accommodative interest rate policy for longer than we otherwise would. And that has definite investment implications. We've seen 2 interesting developments over the last 6 months, one on the virus and one just specific to credit. If we can just move to 4 and then page 4 and then quickly to page 5. On the virus side, with the exception of very recently, on the virus side, we've seen a pretty dramatic decline in case counts. And I think now there's a difference between developed markets and developing markets that's become very pronounced. And obviously vaccination rates, you can see on page 4, in the US and the UK have been very, very successful. and on the continent and developed countries, a lot less so. So one concern I have is the effect on countries that are large emerging market countries, particularly in an environment of rising interest rates and lack of control of vaccination and COVID case counts. The short term, in my opinion, is a bit unclear. One of the benefits of the government stimulus and interest rate policy has been a meaningful reopening of capital markets. And the result of that means companies that were considered at risk 6 or 12 months ago can now access capital from the public market without government purchases. So the result has been a remarkable collapse in default rates. And so we can see on page 5 the magnitude of the decline, and it's really quite remarkable. So what this slide looks at is the entire leveraged finance universe in the US and how many companies defaulted. So if you look at just June, you had about 20 companies default. They happened to be fairly large at that time, so that was companies like Hertz. And now when you look at the last 3 months, there's a total of only 5. And these are very big markets. So if you look at the market overall, this is contextually a market of about $2 trillion. So to have so few defaults is very, very positive for credit because companies are accessing capital, they're refinancing, they're not necessarily taking on more net debt once you adjust for cash, but the cost of financing is collapsing. And so that bodes very, very well for kind of what I think the next 12 to 24 month credit environment looks like. And so that kind of brings me to what I feel the main risk factor is in markets, which is interest rates. We've been in an environment for almost 30 years where interest rates have been in secular decline. And you can see that on the next page visually. And I think one of the interesting aspects of this is, one, I think we're now changing environments. It's hard to say what the magnitude of rising rates will be over the next 5 years or so, but I think directionally they will be going up. And the other important point is most investment professionals have not worked in an environment of rising interest rates because there hasn't been rising interest rates since the 1980s. And so it's just not something that is within the realm of knowledge of a lot of the investment population. And in my opinion, that's going to create some opportunities that I'm going to touch on in a moment. The stimulus has resulted in rising yields. So what we did is we looked at this slide and then sort of blew up the last 15-month period. So you could see it more clearly, which is on the next slide, page 7. So this basically, what we did is we separated this into the nominal interest rate, which is just whatever the interest rate is of 10-year treasuries, and then the real interest rate, which takes the 10-year treasury rate and takes away the inflation expectations. And so what you see is the extraordinary monetary stimulus created real interest rates that are negative, which means, the 10-year treasury was yielding below the expected rate of inflation. And that's still the case today. And that's an extraordinary economic stimulus right there. But I think the market will begin to take that back, and it's already begun, but it's been such a big move over the last quarter. I think there's going to need to be some more data that actually supports rising inflation or any kind of job pressure before rates take another big move. But certainly when I think about this over the next few years, this is definitely the biggest risk in the system, is the degree of stimulus. If there is big economic growth and a recovery in the job market, at some point that stimulus needs to be taken back. And if it's taken back too slowly, either the markets do what I would call a riot, or the government has to then accelerate interest rate rises to make up for what should have happened earlier. So this is what we're looking at the most closely. I think the fear of rising interest rates has resulted in some pretty meaningful asset allocation changes. On page 8, we laid out two things. One is, so what happens to fixed rate bonds when rates rise? Because when fixed rate bonds are only yielding 0.5% or 1% or 2%, they become very asymmetric if rates rise. We just said, okay, a 1% a year rise in rates, what happens? Well, if you look at a 30-year, it's a 20 price point decline. So what we're seeing is a fairly significant shift from public pensions into alternative credit. And the reasoning behind that is in alternative credit or a liquid credit, we can invest without taking interest rate risk. And that's something I'm going to touch on when I just give a really high level review of the portfolio and the portfolio changes. But it's been very, very significant. Normally, credit is pretty far down there on the far right. I've actually never seen it this high, and I've been doing this a very long time. And I think it's, the need for yield and having an alternative to kind of investing in traditional fixed income because the yields are so low now is what's driving this. And from our point of view, our primary client base is public pensions. And I think the effect of the rate environment is pretty complex because on the one hand, interest rates go up, that reduces the pension liability, so that's a good thing. On the other hand, fixed rate exposures go down. So there's always some kind of balance here. And I think that's why alternative credit looks pretty interesting. So if we could move to page 9, please. So you could think of this as our advertising page, but I'm just going to be brief and really focus on the environment and the changing environments. So our portfolio for LACERA currently has about just under 530 million invested. In addition, there was a recent increase of 150 million about 2 weeks ago, which we very much appreciate. And the return has been, from an IRR perspective, 46%. And that really was reflective of the environment where we were in that we had very disrupted capital markets. The price for less liquid credit had diverged to a historical cheapness versus more on-the-run credits. And we were also able to really rotate the portfolio pretty dramatically during the course of the year. And now that we're in a different environment where markets have recovered, what we've been doing is investing much more in private lending exposures that are floating rate without fixed rate exposure. And I would say the portfolio overall, if I look at it over the last year, is probably over 95% floating rate. So we kind of took the view that rates would rise and wanted to avoid the situation that we would have a credit gain, but then a rate loss, so that LACERA's exposure really was a credit exposure. So the last thing I wanted to touch on, because I'm conscious of time before we move on to questions, is our investment outlook. Like today, what are we putting capital in this portfolio that we think meets LACERA's return and risk requirements? So if we could just move to page 10, please. So there's a number of areas, but there are 2 of the 3 areas are concentrated around the consumer, and then 1 is corporate. And these are areas that we looked in March. This time clock that we have is our investment outlook for different products. We've used this for a number of years. So if you go back to March 2020, you can see where our time clock actually was on these investments. And it was reasonably unattractive. And our reasoning behind that is there were better illiquid credit opportunities in the public markets. And so that's what we invested the capital in. Now we're going the other way, which is taking gains and reinvesting in more private markets. And the 2 consumer areas, One is short duration loans on residential real estate properties that are being fixed up. And these have a very significant amount of subordination. And they provide about a 7% kind of loan level yield and a 12-month term. So they replenish over time, and there isn't any duration risk. And we don't have to have a long-term view of the economy. We just have to have a view on the next 12 months on what we think about specific residential real estate opportunities. The second is private consumer credit. And here we don't take first loss on consumer risk because it can be the riskiest when the economy changes. But what we're really looking at are structured transactions of near prime borrowers, which right now, between the recovery of the top half of the income group and the economic stimulus, is a very, very attractive investment with very limited losses. And there's a risk premium there because, of course, 12 months ago, it looked like the world was ending. And the last is structured corporate exposure. So as I mentioned, we are seeing a collapse in default rates, yet there are certain assets that still have risk premiums. One asset is short-dated payment obligations. And this is really for liquidity reasons, but we're investing kind of 1 to 6 months at a 10 to 15% asset level yield, generally on companies that are pretty household name companies. They might be rated single A, they might be rated triple B, they might be rated double B. Very short duration. So again, we're not taking a view on where's the economy going to be 5 years from now. We're taking more of a credit underwriting approach of the specific companies. So those are the main themes that we wanted to touch on. So I'm happy to answer any questions.
Great, thank you. So we have 3 minutes and 2 questions. So we'll begin with her.
Okay.
Thank you, Mr. Dorfman, for your presentation. My question goes to inflation risk. If you can briefly compare our environment right now versus the great financial crisis that we had in 2008, 2009, and there was stimulus as well in 2008. Everybody was concerned with inflation. If I remember correctly, we struggled to get up to 2%, which is the ideal rate that Chairman Jay Powell stated, and also the fact that the CEO of JP Morgan is suspecting a boom. I believe he said that we're going to grow anywhere from 7 to 10% in GDP. So if you can elaborate a little bit in terms of inflation and how is it that today is different than in 2008, 2009?
Sure. I think the biggest difference is there's no precedent for what's happened over the last 12 months because we really had an economy that almost closed down and then a massive fiscal and monetary response. So the difficulty is right now, there are some really, really sophisticated people who say, oh, we're going to move into a really, really high inflation environment. And they're equally as sophisticated people who say, well, we're actually not going to because of labor, technology, kind of permanent price disinflation from destructive technology. But it's really difficult to know what's going to happen because this is so different than the post-GFC environments. There, the economy didn't close. We really had a financial crisis. Here we had a closed economy that is now reopening with more money thrown in it than it's ever happened before. So that's why I worry about inflation. I don't think it would get out of control, but it can certainly rise, and that can cause a lot of price damage with very limited yield movements. So that's what I get concerned about. But I do view them as pretty distinct economic cycles.
Okay, Mr. Kelly, you have 1 minute.
Thank you. I had a comment, which was you noted that the great majority of investment professionals have not seen a period of rising interest rates. And that reminded me, I recently found cleaning out my garage a 1974 win button that I had obtained in the Gerald Ford campaign with inflation now. So thank you for making me feel so old first thing in the morning.
And
Well,
with that.
I was also working in the 1980s, so unfortunately I'm on the wrong side of it myself.
Well, with that, thank you so much. That was an excellent presentation. And so we'll move on then to items for staff review. I don't believe we have any.
No, we do not.
Okay, great. Any
Thank
comments
you.
for good of the order? Do we have any comments for good of the order?
Mr. Knox?
Yes.
I'm sorry, okay, you do have a comment or no?
If anybody has a comment, just speak up. Otherwise, we'll go to adjournment.
No comment.
That was a no comment.
No comment.
Okay, right. We're
I
going to
just
call
got a-
that no comments.
A
Yeah.
question to Mr. Nags. How long before we begin the meeting?
Let me ask Chairwoman Sanchez. I don't want to short you like last month.
No, that's fine.
Okay,
We're
how
done.
about
It's not-
3 minutes?
Okay, we need an adjournment.
I'll move to adjourn for 3 minutes to the next meeting starts.
Thank you.
Second.
This meeting is adjourned. Thank you, everyone.
Yeah.